Hello out there, world. This is Gary Meek living in Sacramento, and I am with one of my most favorite people, Miss Stacey Medinas. She is my lender extraordinaire, also a very, very long time dear friend. So we're going to talk mortgage today. You guys are in the process of thinking about buying a house, and this is one of the steps. So Stacey, I'm going to go ahead and ask you, when someone comes to you, or if I refer someone to you, which I refer a lot of people to you, what is the very first thing they're going to be talking to you about?
So thanks so much for having me, by the way. I'm super excited about this, and I love working with all buyers, but first-time home buyers kind of have a special part of my heart because they do need the mama, right? And they want people to hold their hand, and they have thousands of questions, and that my team is perfectly set up for that. So I just wanted to mention that. But yeah, I mean, the first thing that they're going to do is have a conversation with me. I'm 100% referral. So people like you refer the buyers to me. 95% of the time, that's how the buyers come to me, is through their realtor. And so that's really important. So I'm going to have a conversation with them. I kind of go through what are their hopes and dreams and what are their fears, and try to answer all the questions that I can up front. Because a lot of times they're prepared with questions and they have doubt and they're worried, right? And it's exciting and scary all at the same time. So we'll have an initial conversation in the beginning to kind of go over how can I meet their needs.
Okay, very, very cool. And then how do you kind of decide what program to kind of put them in? I mean, there's tons of different programs out there. Is that based on the discussion you guys have? You'll kind of gather the information and then kind of direct them?
100%.
Okay.
Yeah.
So before they have a conversation with you, they don't know what to ask. Why don't we go over maybe a couple of the programs that are out there so people have a basic understanding?
Yeah. So when I talk to them, I ask a lot of questions. That is one thing about being experienced in this industry. And maybe it's a personality trait too. I can get all the information from people and break it down as to where they need to be. But yeah, they do ask specific questions like, do you have down payment assistance programs? Do you do VA and FHA loans, USDA? So there are 4 basic products. And so we'll start with FHA. So that's a very common first-time home buyer product because they're very flexible with FICO scores. And sometimes the first-time home buyers don't have an 800 score, right?
Gotcha.
I do find them, but it's rare. And so it's higher debt to income ratios, so they can have a little bit of debt and less income. And the down payment is 3.5%. So it's used a lot for first-time home buyers, okay? But all people use, when I did my first loan, not my first loan, but a loan recently, I did an FHA loan because of whatever the makeup of the loan is. It's kind of like a puzzle, right?
Gotcha.
So FHA is one. VA, of course, which is for veterans or retired people or active, okay? So VA is 100% financing. It's an amazing product. We have USDA, which is for rural properties, which amazingly enough, there's a lot of places that still fit into that box, and that is no down payment as well. Down payment assistance, which is a whole different animal, right? But those partner with FHA and conventional loans. So when we talk down payment assistance, it's not its own separate loan. It partners with the other loan products. And then we have a conventional loan, which is normally what we would use for someone that has 20% down or even 10% down with a better credit score. So for basic products, there's lots of them out there, but that's really what we see on a daily basis.
Gotcha. Let's talk about the qualification process because people may not understand. You mentioned words, LTV, debt,
different language.
Yeah, which I know, of course, because I've been doing this for 20 years. But why don't we talk about a couple of those things that they need to understand?
Definitions, yes. Yeah. So loan to value, or LTV, is something that you will hear. And that is a comparison between what the home is worth and what you're borrowing. So 20% down is an 80% LTV. You start with 100%, you put 20% down, you have 80% left. That's the loan to value piece. Debt to income ratio, or DTI, is your debt in comparison to your income. For example, on an FHA loan, because they're a little bit more lenient on that percentage, you have $5,000 a month 50% of that is $2,500. That's what you have to use towards your housing, whatever the mortgage payment is, and all of your debts. So that's a quick math on that, right?
Okay.
You just go 5,000, divide that by 2, it's 50%. That's all you can have. So it's always a rough justice, easy math.
Gotcha.
Credit score, I think a lot of people know what the FICO is, right? Credit score. We use a tri-merge. So we pull all 3 bureaus. We take the mid score, the lowest mid score. So if it's a husband and wife, we look at both of their credits and they're going to be on the loan. We take the lowest mid.
Okay, good to know. Let's talk about the breakdown of that payment, that $2,500.
Right.
Most people don't quite understand what's in there. So let's talk about the PITI, right?
Yeah, PITI. So PI is principal and interest. So that is the straight, just the principal and interest of what you're borrowing. On top of that, you're going to have taxes, which are property taxes. The calculation is 1.25% is a general rule. Now, every property is a little bit different, but that's how we kind of do it very quickly. You have taxes, which would be, insurance, which would be homeowner's insurance.
Okay.
That calculation, again, general is 0.35%. But then if you put less than 20% down or you use an FHA loan, you have mortgage insurance. Now, FHA loans have mortgage insurance regardless of your credit score or how much you're putting down, and it's for life. So you have to refinance out of that once you have enough equity to get out of that FHA loan. But yes, mortgage insurance. So it's principal, interest, taxes, and insurance, plus mortgage insurance, depending on the.
Gotcha. And then what of that can they write off on taxes? I know you're not a tax professional, but
I am not a tax professional.
There's certain things we're allowed.
Write off the mortgage interest, 100%. Now, the mortgage insurance has been an up and down the last couple of years, so it'll just depend. And that's something I would always ask them to talk to their CPA or, even TurboTax or whoever will be able to help them with that. But yeah, interest, mortgage interest, which is another thing that, I don't want to go off on a tangent on that, but people that have never owned a home don't understand the amazing tax implications and how it helps them with their taxes, being able to write that off as interest because they've been renters and they didn't know they were paying someone else's mortgage, right?
Yeah,
so you're right. I mean, that mortgage interest is amazing.
Gotcha. Very cool. Now, so if someone has a $2,500 payment, how much of that is interest up front? I mean, not exactly dollar for dollar, but are we talking 50% of it or what?
It's 2/3.
Thirds.
And
Wow.
for the first few years, it's probably more than that.
Gotcha.
So it's a good amount of it is interest.
Okay. Good to know. Good to know.
But the way to sort of get around that, I mean, that's the little trick that we teach people is make one additional payment towards your principal balance only annually. And it will take a 30-year loan. I think the last calculation was to a 26-year loan.
Okay.
So think about if you made 2 full extra payments, it just ticks down that amount and helps you, get rid of that interest faster. But towards principal balance only.
Gotcha. Okay. You mentioned the word FICO earlier, which, like I said, I know what that term is, but I get people come to me all the time like, I checked my Credit Karma. I'm at 620. I mean, how realistic is Credit Karma?
It's not. And it doesn't really relate to mortgage lending at all because we do a tri-merge, right? We pull all 3.
Yep.
It's a good indicator. I mean, I'm not going to say that it's complete. I mean, it's usually pretty off. But I mean, if you're at a 620, we've got some work to do, right? If it says you're at a 700, the chances are you're probably in there. You're 680 to 700. But if it's saying it's 500, we know that we've got some love. We need some TLC on that, which I can help with. I mean, we're not credit repair people, but I've been in the business so long, we know exactly what to do. We could run a what if simulator and it tells us pretty close. We'll say, hey, we want to get a 680 score. What do they need to do? It'll say, pay this account down from 9,000 to 5,000 or pay off this collection. And so it gives us a little bit of a roadmap at least. So it's not an exact science, but it does help.
Gotcha. Very cool. What would you say is the most common scenario you get in today's market?
Oh gosh. I think people with challenged credit, unfortunately.
Okay.
And it's because you don't know what you don't know, right?
Mhm.
And so when I have that initial conversation with them and they say, "Oh, we think our credit's a little rough, right? And should we pay something down? Should we pay off the collections?" I'm like, stop. Do nothing until we've reviewed it, because that's what we do all day long. And I can analyze it, and I'm going to know what the actual credit score is that we're going to use for financing. That, the Credit Karma or even the credit cards have their own where you can pull it and it'll tell you what the score is. We need to look at it because, for instance, collections, they don't count medical collections. So those are just out. And then people go back and pay a bunch of them and for nothing, right? We should have saved that money.
Okay.
Other debts, don't do anything until we looked at it, because sometimes it's best just to leave, especially a derogatory account at least for now.
Yep.
Because if it's old, say it's 5 years old, but it's still affecting your credit, when you pay it off, it becomes a recent derogatory instead of a 5-year-old derogatory.
Wow. Okay.
Yeah, so that's funky. So it could do the opposite of what we're trying to accomplish, which is boost the score.
Gotcha. All right. So we kind of covered, the most part of the beginning stages, right?
Yeah.
What does it look like as they're going through the process, right? I have my part that I'm going to talk about in another video that is going to be the real estate contract. But let's talk about the process for the loan officer. Someone comes to you, I referred them, you've got them pre-approved.
Yeah.
What are the next steps from there?
So once they're pre-approved, of course, it does go back to you. So I will communicate with the clients, go over all the details, make sure that we're all on the same page. How much are they going to put down? What's their loan program? What is the interest rate that day? Which of course they change 5 times a day. But what is it that day, and what does their payment look like, right?
Yep.
And then they need to decide, is that price point the right price point for me? Then you go out shopping. Once you're ready to make offers, you'll call me and I will send a pre-approval letter for that exact dollar amount. Say that they're pre-approved for $500,000, but you're making an offer at $440,000. We certainly don't want to send a pre-approval letter that says they're pre-approved at $500,000, because that messes up the negotiation, right?
True.
So I'm going to send over the pre-approval letters as you guys are shopping and as you guys are making offers. I always communicate with the listing agent to make sure that they understand the buyer and our process. As a mortgage broker, I think we're approved with like 40 lenders.
Okay.
We use, a top 5, and I use a top 2 because I have my favorites, right?
Yeah.
But we have the ability to do any type of loan, really.
Okay.
But yeah, so once you guys are out shopping, we're just waiting. Once we're actually in contract, we can go into that. I mean, are you ready for that?
Yeah, let's go. Let's jump right into it for sure.
Yeah, so in contract, so you're going to say, yay, we're in contract. So I always send a little happy video to the clients and the realtor to say, hey, congratulations. And basically what's next, because that's what everybody wants to know.
Yep.
We have a contract. We're supposed to close in 20 days, 30 days, whatever. What happens next, right? Yep. So what happens next is you're going to send me escrow information in the contract. We're going to then review it and determine who's paying for what, kind of sort out all the numbers. And then we are immediately going to contact the client to tell them what the current rate is that day.
Okay.
Determine whether they want to float or lock their interest rate, and what are the costs, because there's so many variations. Sometimes clients are like, hey, I want a 6%, but the cost is, $1,000 or something. So they're like, well, let's wait. I don't want to pay. I just want that rate. So that we kind of play the market. It's a little bit of a gamble. I have one right now that we're doing ever. So float or lock, we're going to immediately send out disclosures. Those come via email, okay? And they're all DocuSign. Super simple. Once that is signed, then we order the appraisal. Now, with my clients, I always credit back the appraisal at closing. So that's one of their upfront costs, is an appraisal. The only upfront cost with me, they're going to have different things, inspections, as far on your part. But as far as I'm concerned, we're going to order the appraisal, and then we immediately submit the loan into underwriting, because, we're good like that. We've already gathered all the documents.
Okay.
We're ready to go right then. Yes. Gotcha. We already have everything we need. Sometimes we need an updated pay stub or a bank statement, depending on how long. Yeah. But my average closings right now are 14 days.
Okay.
I'm ready to close half the time, and people are like, we're not ready to close, you know? So it's going very fast. We're getting same day approvals. So once we submitted to underwriting, same day, maybe next day, depending on what time of the day it gets submitted.
Okay.
We have an approval. So now we have conditional approval. We're now waiting for the appraisal, of course. And sometimes there's stuff that we need from you, from escrow, from the buyers. And my assistant, Dawn, will then send out an email to all parties saying, yay, we have conditional approval, and here's what we need from each person.
Okay.
And then normally we're just waiting for that appraisal.
All right. So we go into underwriting. That is, someone is reviewing that file, checking it all out, making sure the I's are dotted, T's are crossed, verifying employment, making sure someone's not doing anything silly.
Right. Well, we've already very closely vetted them. Trust me.
Oh, okay.
It's very rare that it gets to underwriting, at least on my desk, with something that's off. Right. We have gone through that with a fine tooth comb. It's my reputation, you know, make sure that, it was very calming.
Oh, yes. I remember those days.
Yeah.
Yes, I remember those days. All right. So underwriting comes back, approved, appraisals in, value is good, hopefully.
Rocket.
And then what's next for you guys?
So if we haven't locked at that point, we absolutely have to lock, right?
Okay.
Because we have to get to the clear to close stage. So once the appraisal's in, it gets submitted back to underwriting. With the appraisal, any conditions that we've gathered in the meantime, the loan is now locked. Within 24 hours, usually less, we have what's called clear to close. Those are our favorite words in lending. You know, it's on record is what the real estate agents love.
Yes.
Cleared to close is our happy sound, right? So, and then we're ready to sign. I mean, literally usually sign the next day. And then, you know, and signing means that the signer could come to them to sign their final loan docs, which they have to do in person, or they can go to escrow and sign their final loan docs.
Cool. Very good. So we've covered quite a bit. And I know for the basic person just getting into this, checking this out for the first time, this is all, you know, gobbledygook, right? It's probably a lot of information. And that's the reason we do these videos, is to try and help them understand the process before they get into it. Mm-hmm. Is there anything else that you would add, like things that are, don't do this during your escrow report or anything like that you want to add? Cool.
So by that, I'm going to say thou shalt not. Okay.
Thou shalt not. Okay.
I'm going to read these because these are my favorites. Because all of these have happened, by the way. Change job, become self-employed, or quit your job. I've literally had a client quit right before the loan funded. And we verify. So we verify right before the loan funds verbally. Do they still work there? Uh-huh. Okay, great. They called, they'd quit 2 days. Buy a car, truck, or van, or you may be living in it. Okay? So it's, and honestly, that we laugh about it. It's okay because sometimes things happen. You get into an accident, you have to get a different car. Just make sure you let us know and get us the paperwork.
Okay.
Use credit cards excessively or let accounts fall behind. Your credit needs to stay the same from the time that you're pre-approved to the time that you fund. You want to buy appliances? Wait until after you close. Spend money you've set aside for closing. So all the money that we verified that you're going to be using, it needs to stay there. And I know that, you know, we have to pay bills and, you know, things happen, but that dollar amount, if it's going to fluctuate, needs to stay so that you still have closing costs and down payment.
Okay.
Omit debts and liabilities from your loan application. We're going to find out, so don't leave anything off. But we are forensic, unfortunately. Make any credit inquiries or open any new accounts. I think that kind of goes with the other one. Originate any inquiries into your credit, meaning you're out shopping for, you know, furniture and 0%. No, nothing. Do nothing. Make large deposits without checking with your loan officer. A lot of times people go, oh my gosh, I have this mattress money, I'm going to go deposit it. Don't do that. Just leave your bank accounts the way that they were when we saw them, as close as possible. Change bank accounts or co-sign a loan for anyone. So much stuff happens. I mean, we're human and this is life, right? But I get calls from people all the time. Is it okay if I do this? Is it okay if I do that? Just call me. It'll be fine. And we'll work it out and I'll find an alternative for you.
Okay. Sounds good.
That's it.
Awesome. Well, we appreciate it. Thank you so much for being here. For you guys watching online, I'm going to include Stacey. What she just read is on a PDF. We're going to include a link for that down below. I'm also going to include all her information, which includes her phone number as well as her email address. If you'd like to reach out to her and start the process for getting pre-approved. So
Yes. Thank you so much, Gary, for having me. I appreciate it.
always nice to talk to you and hang out with you. And we'll see you soon.
Okay.
Thanks again.
Thank you.
Bye.